Welcome to TheoTrade. This is Don Kaufman. July 10th, 2017. Got about 9 minutes left in the trading day, but for this evening video, I want to really step away from some of the intraday trade. Sure, the S&Ps are up about, 4 or 5 points over here. The Nasdaq, once again, is Mr. Toad's wild ride, having about a 60-point range. But as I said, I really want to step away from some of the intraday trade. We can point out Amazon. Come on, it's Member Prime Day starting tonight. You guys know you're going to buy something, right? Something just to be part of it. I am not. I will sit out this next Prime Day. Maybe. Anyway, taking a look at markets over here, I want to bring up in this evening's video a bit about correlation. So over the weekend, I happened to see a blurb out by a quantitative firm. And the quantitative firm was just simply pointing out that ultimately, if you looked at the S&P 500 versus the Dow, it has been since 2003 since the two products have been so uncorrelated. And that ultimately means, okay, if you were to look at the S&Ps, it's like the S&Ps are going up, the Dow is going down, and or vice versa. So I decided this evening to kind of look at some of this myself, and I look at correlations pretty consistently. And this is one that I've brought up a number of times here at TheoTrade, but allow me to take you through this, to take a little bit deeper into it. And again, we're stepping away from some of the intraday trade. You just have to look at this and think to yourself, and again, what we're about to explain here, this is the QQQ versus IWM versus Spider. It's a comparison chart, and it's a comparison chart over the last 3 months. Okay, and if you've looked at comparison charts in the past, most of the time you get products moving in relative tandem, right? The spiders come up, the Qs come up, they sell off, these sell off, maybe a little bit of crossover here, but for the most part, products tend to move in relative tandem as they oscillate up and down, okay? In some of the most current trade in the last 3 months, it's pure and utter chaos out there. And again, I want to show you what is what. Right here, okay, and as I'm drawing a little dash next to it, that happens to be the Qs, okay, which is representative of the Nasdaq. All right, this little guy right here happens to be none other than the IWM, and last but not least, on the bottom here is the spiders. Now, I've decided in this comparison to use the ETF products because I thought it was the most representative of the S&P, the QQQ, and the Russell, respectively. All right, so what do we see in the last 3 months? Clearly, they're all over the place. Now, if you took a look, for example, for 5 years, this is what I mean when I say that they move in relative harmony and a little bit of crossover. It's pretty evident that, and this is something I've mentioned numerous times, that the Nasdaq has pulled away substantially from the S&Ps and the Russell. Okay, newsflash, well, that's nothing new, okay? But what we are seeing in the most current period is clearly a bit of, again, the Nasdaq selling off into and compressing into the other major indices. It's as simple as this. If you look at the idea, okay, of comparison charts, and I'll go back here even to a 10-year monthly. If you look at the idea of kind of expansion and contraction, I mean, that's what these pairs are predominantly about. Here's, again, a huge expansion from the Nasdaq away, of course, from the IWM and the spiders, okay? Right now, you can see in the most short duration that these products are, in fact, contracting upon one another. And that's typically in the midst of bouts of extreme volatility. Now, here's the point to be made with this, because you're looking at this, you're like, great, newsflash, Don, I realize that the Nasdaq is going down. Yeah, but I looked back, and I looked back at a lot of correlations, and I'm going to show you one here in just a moment. And I looked back at those correlations versus, let's say, for example, the VIX, okay, because lots of people look at the VIX. And the one thing that really struck me is that any time we actually have seen this contraction, if you will, and that is the Nasdaq coming down, for example, to the S&Ps and to the IWM, there have been bouts of extreme and extraordinary volatility, none of which we have seen. And again, I'm going to blank this chart for just a moment and take you over to the VIX, because a moment ago I was talking about the most recent 3 months. And in the most recent 3 months, we've seen, again, some of this contraction, and that is the Nasdaq coming down towards the S&Ps. And yeah, where's the bouts of volatility? I mean, come on, we almost got up to 15 on the VIX over here, bestill my heart. It's been nothing. Now, let me back out for just a moment. We're going to go back to the Qs. Okay, so we're going to go back over to the Nasdaq, and I'm going to set up a comparison chart for you and show you the correlations and really show you ultimately, if you will, how out of sorts and kind of out of whack the market happens to be. I mean, everywhere you look, before I show this, everywhere you look, you can look at the bond relationship. You got to scratch your head on this one. The bonds have been straight down the last, 2 weeks of trade. What's the impact and the broader implications to the market? It hasn't been felt in the market. You have the Nasdaq all over the place. I mean, literally all over the place. We've seen nothing less, than about 50-point moves. And today's a slow day, and it's a 60-point move inside of the Nasdaq. Volatility, there isn't any. Okay, I can go on all day long. Oil, breaching into lows over here. Of all the correlations and coefficients that we typically look at, okay, nothing right now speaks to more chaos in the market than what you're about to see in the Qs, again, versus the S&Ps. So I'll open up here to the QQQ, and just to show you how to do this, this is specific to thinkorswim. Come over here to studies, go add study, drop down to compare with, come up and do this for yourself. Go to custom symbol and type in, for example, something like the spiders. So all I want to do initially is compare the Qs to the spiders. Now, when you're doing a comparison chart, it's important not to use candles. Come over here to candle, change it to line to line, give you an even comparison. Next, I come over here, click on this sprocket, go right over here to equities. I want to get rid of the volume subgraph. Hit apply, hit OK, and a comparison chart. We don't need no stinking volume. Last but definitely not least, I'm going to come up to the study beaker. I know it's an Erlenmeyer flask. Come up to the study beaker over here. Come in there, type in correlation. All right, double click on correlation. From correlation, click on its sprocket. I want to correlate the Qs specifically to the spiders. Okay, and I want to do it on a length of 20 days. So I do want a little bit more duration in there, a length of just about 20 days in terms of that correlation. Hit OK, hit apply, hit OK, and we got ourselves a correlation study. Now this is over the last 3 months. Now I can start to back it out in time. Let's go look, for example, for 1 year. I want you to see what's going on over here because again, you can pull this up for a multitude of years. Most of the time, the Nasdaq and the S&P are moving at a rate for almost 1-to-1. And we saw little glimpses even last year, right? After the election, hey, things got crazy in November, right? The correlation kind of backed off. And I'll explain a little bit about this correlation as well, because this is, again, kind of chaos a brewing. And I know everybody wants me to, well, what is it? What do we make of this? We're not sure yet. And there's the closing bell. We're not sure yet entirely what to make of this, and I'll come to that here in a moment. But what I want to back out and display to you is you can even go back to like 3 years. You can go back to 3 years, and there have been short glimpses of the Nasdaq and the S&P not being correlated. But you have to realize right now we're coming out of a state where there was zero correlation. I mean, literally, if you zoom into this little, valley over here, that's a 0.10 correlation. That means there was only a 10% correlation between the S&Ps and the Nasdaq. And we all know, okay, that the same stocks are driving the Nasdaq that are driving the S&P. It's the same Microsoft, the Facebook, the Apple, the Google, the Amazon. And yet it doesn't matter that the asset they're not correlated over there. And you have to realize what some of the implications happen to be. Portfolio managers that use things like beta weighting. Beta weighting doesn't work when asset classes are not correlated. So, oh my gosh, risk could be extraordinary right now. You know, if you look at like the Fed, and the Fed does these stress tests out there, right? Those stress tests are done via beta weighting, what's called R-squared methodology. They don't mean anything if markets don't hold correlations. That's some of the implications over here that we're kind of playing with fire ultimately. Anyway, you can back out, even go out 10 years, 15 years, go to 15-year daily. And for a 0.1 correlation, I started kind of cruising back and I'm like, well, where's the last time we even saw like a 0.1 correlation? And that's right, we're still cruising back. And we got to actually come all the way back. And again, I don't want to make any relationship to 2007, 2008, but you had to come all the way back into, all right, this is what, late 2007 to really find these two asset classes that have less of a correlation than they recently did. And clearly this was, you know, risk over there. Now, I am not trying to constitute that, you know, what causation is ultimately, or correlation equals causation, that because it happens once, it's going to happen again. But for right now, okay, you got to be on your game in this market. You know, again, seeing asset classes having as little correlation as they currently do. And I know that we came out of it, but we're still right now only back to a 73% correlation of the Nasdaq versus the S&P. And by the way, there's some of the trades that we've been doing lately, like these tetrapod spreads, they're directly facing this trade, meaning that we're literally selling premium in one and buying premium in the other because this is working for us. However, again, you got to be on your game when asset classes are not correlated. And again, right now, I don't think anybody knows what the implications are to the forward future, other than most of the standardized and classical ways that we manage risk, okay, they're off the table right now. Because again, when asset classes aren't correlated, I mean, you start talking about, well, I was well diversified. What does diversification mean, okay, when we get a breakdown of correlations that have been around since pretty much the beginning of these index products? That is ultimately what I'll leave you with, and I'll come back to this a little bit later in the week as I start to run more correlations with things like bond products and the bonds being correlated to the S&Ps, or inverse correlations. And again, anytime in the past when I looked back over that 15-year period, okay, these periods of non-correlation were actually met by bouts of really like just violence in terms of volatility. And that was specifically the VIX spiking. That is the one thing that I cannot see right now. We haven't seen any real violence, if you will, in terms of the VIX. Thanks everybody for joining us here at TheoTrade. Have a wonderful evening. Bye-bye.